Boy with Accounting Accidentally. This video is called Starbucks Complexity and Investment Objective. And authors note that my fifth book, How to Manage Personal Finances, will be out in early 2025. You can find all the chapters explained here at Accounting Accidentally at Substack.com, and you can also email me at ken@stltest.net for the book's publishing date. So Starbucks has a new CEO. Brian Niccol comes from Chipotle, and before that, he was with Taco Bell. And the question is, why did this happen? Why did they switch CEOs? Well, part of the problem is that you can order such specific items at Starbucks that the labor cost to fill all these specialized orders, the supply chain, has all become so complicated, it has really impacted Starbucks' profitability and also their ability to get drinks out, specialized drinks to people who are in the restaurant. So this is the reason that Starbucks made this change. They need to streamline the process, and they may even, there's speculation, make the menu a little less complicated with a few less options so that supply chain and labor costs can be managed. So why do I bring up Starbucks? Well, I've talked throughout the book about complexity, whether it's complexity in business or complexity with investing. And complexity creates several problems. The first is, with so many choices and options, it's hard to make a decision. And with so many choices and options, you often make the wrong decision. And one way to prevent that is to clearly understand investment objectives, which is what we'll talk about now. So let's talk about mutual fund objectives. And for starters, there's several types. The first is an investment advisor discussion. Investment advisors must discuss investment objectives with you and document that discussion. And this step helps the advisor recommend suitable investments. This is designed to protect investors and ensure that the investment advisor has the background on what your objectives are before they recommend anything. The other case is, and this may not involve a broker, an advisor, depending on how you invest, is mutual funds. Every mutual fund publishes its investment objective and prospectus in the summary prospectus, the shorter version. The idea is to find a fund that matches the investor's objective. So for example, Blue Chip Stock Fund invests in the stocks of large US-based businesses with consistent profits. If that matches your objectives, based on your review of what you want to do, that objective might match what you want to do, and you invest in that fund. So those are the two sources. Now let's talk about specifics. The first is time horizon. How long are you investing for? Are you saving money to buy a house in 5 years? Are you retiring in 20 years? Time horizon, how long? You need to be clear about the time horizon because that will impact the cost you're willing to pay for the investment and how much risk you're willing to take. For example, mutual fund investing has costs, and if you're investing for a very short period of time, say 6 months, because you're just putting money aside for a down payment on a house, some mutual funds may be too expensive relative to other investments. So that's time horizon. Risk tolerance, which I've talked about, you'll see here at the bottom in Chapter 16, Investment Mistakes. You can go back and look at investment mistakes to talk about risk. If the value of your portfolio declined 20% in 1 year, is that something you could live with? How about 10%? What percentage are you willing to live with? When people think about investment risk, they first consider the upside, the gains. However, in my view, the first consideration should be possible losses and looking at that on a percentage basis. Another good thing to remember is the longer you have to invest, the more time you have to make up for losses, which is why young people generally will invest more money in stocks, because if the stock portfolio has losses, they have many years to make up for any losses. And finally, a point that I think gets ignored and not discussed, which is your personal time investment. How much time are you willing to invest to monitor the performance of your mutual funds and other investments and consider making changes? If investments are new to you, you'll have more time up front. You'll have to invest more time up front to understand the process. If you don't have a lot of time or you're inexperienced, consider paying a fee to an investment advisor who can do that for you. This is the one that gets ignored. How much time personally are you willing to put in? So that's a discussion of investment objectives. So to wrap up, think carefully about what your goals and objectives are. I recommend having a discussion with an investment advisor, not doing it on your own. Then you can have a clear path as to the types of investments that match your objective.